This video, we are still um, trading the markets live. It's about 2:15 to 30 in the afternoon today on Friday, the 6th of November. So, just to get things started, once again, we have the Nifty chart in front of us, and as we have discussed broadly before, that this is a structurally a ranging chart, and one of the ways in which we identify a ranging chart is by simply taking any moving average crossover. So, for example, I can choose the 2050 moving average crossover, and when I see frequent crosses at the periodic intervals, that is a sign of a ranging chart. As compared to, for example, a stock like this one, this here we will see that the last crossover somewhere in 2020 April, which is during COVID time, and since then we are seeing a consistently upward moving chart which is creating new highs. This is the chart of Navin Fluoride, or similarly, if we have a look at some stock like this one, this is Dixon Technology. Once again, we see the market, this particular stock ranged in this for a while. It broke out, and since then we are seeing continuous healthy upward trend. Anyways, coming back to the chart at hand, which is Nifty. So we have an understanding that, broadly speaking, that this market is in a structural range. We have also discussed that because of the fall that we sort of uh, experienced from here. So we had already discussed that the bearish bat pattern happens at a confluence of 0.886 of the overall XA length, and this was at 0.867, pretty accurate. 11,800 was the resistance point, as we had mentioned earlier. The market did get resisted. However, we have seen that after creating a lower top, lower bottom formation for a brief period, the market went on to subsequently take out this high. And once what is theoretically known as a PRZ, which is a potential reversal zone in price, the structure gets, if it is taken out even on any closing basis, the structure completely gets negated. And therefore, since this PRZ worked for the first leg, but subsequent leg we can clearly see that it failed, we understand that the bearish bat pattern is no longer in play, and the only possibility, given the nature of this you could say geometry, is now the possibility of a bearish crab pattern, which will come into play only at approximately 13,000 Nifty, somewhere around here. So for bearish crab for the same structure, we have to get a significantly higher up, so approximately 1.26, 1.2 as the structure for a potential reversal zone. So with the absence of the bearish bat pattern, the only possibility is a bearish crab pattern, and that too happens only at 13,000 Nifty. So from this point right up till 13,000 Nifty, we are no longer in the premises of a harmonic system, and we have to assess the price action as it is happening. So now, so we have the broader theme in play. Now, when we zoom into the picture, what we basically see is that we had already identified that this particular zone acted out as a resistance, where the market temporarily, after creating a new high here, went on to create a structure that looked like this. And so one of the better ways to see it is by simply replacing candlestick charts by line charts, and you could get a structure that looks like this. It's easier to interpret, but candlestick charts also offer a lot of tactical advantages which can be used, and therefore I generally use them. So after having a lower top, lower bottom formation, it was reasonable to expect something as this as a sorry, this as a possible continuation move. It was reasonable to expect that, but the market had other plans, and instead of this as a continuation move, we simply ended up getting what is known as a new high, and in the process the market completely negated the earlier identified potential reversal zone. So now we just after having an understanding that the market had earlier taken out a range, so just to get a fair bit of understanding that this particular range right here, right here. Um, So okay, we can even settle first till here, all right, and we'll have to connect the low right up till here. So we can see that the 10,800 to 11,800 mark on Nifty has been structurally in place since July. So for July, we had the market ranging in a 1,000 point range, and this range within as we move towards the period of October November, this range subsequently narrowed until somewhere here. So the range shifted after this new high is created, and now we see that this price action, this low of 11,500 Nifty, has technically been on play since August 2018, and this low of 11,008 this high of 12,000 Nifty has been in place since the month of October. So we are again in a 500 point range for a period of roughly 3 months. The question is, uh, how does the recent price action, how relevant is it with reference to the previous range, as is obvious from this chart. So now once we know that the price has structurally been in a range with the anomaly of a high, we do not know if this would have been a double top till this low got supported. So since we know that this price is structurally in a range, when we get a gap formation, when we get a gap formation from the range, the chances are that this gap basically becomes what we call as a breakaway gap. Okay. Sorry. I'm sorry, I just got a call. I'll just call this person back. So the chances are that we are getting. So the call I got was from another trader who has helped me with this particular code, and he and I are to figure out. I mean, he is to teach me basically how to use this code to my advantage. So I'll get back to that. So yeah. So what we have here is basically. I mean, I can just take a arrow. Oh God, this is a bad arrow. So what we have here at this point here is a potential breakaway gap. Now the question is, why potential breakaway gap? Why is it not a normal gap? The reason is because we have clearly established that the preceding price action was a range. It was not creating consistent highs and lows. The highs and lows were inconsistent, and this price action has broadly been tested right from say August, and we are in November. Uh, so, so given the fact that we have this gap coming after a very long range, there is a possibility that this is what we call as a breakaway gap. What are the themes? What are the characteristics of a breakaway gap? So the first one being that the breakout has to be from the range, has to be from a range or a period or a zone of consolidation. So it has to come from there. Only then does it become a breakaway gap. That is point number one. Point number two is there has to be an increase in some volume, increase in volume parameters. Point number three is if the breakaway gap is genuine, then it should lead to a change in trend in the direction of the gap. So we are basically seeing that we have already established that this is a range. We now just have to see if there is some volume supporting this, and if there is volume supporting this and the breakout has been from range, the prima facie hypothesis is necessarily going to be that 11,500 is going to be a low that the market is going to respect. And any positional trader, he could consider, maybe you could wait for the Trump election to completely end, the Trump-Biden election, the US election, sorry. Once that ends, the result may be in Tuesday. If it does not go for litigation, the position becomes safe for writing 11,500 puts and things of that sort. So with this information in mind, we have to just check now for volume. And what we do is I have set up OBB. And so what we do here is, if we see the price here, so we see two things. So I just connect it with this line. We see first of all that whenever this high was created, it was created with an increase in volume, and at this point, even though the market had not created a new high, we are getting clearly new volumes, which has created a higher high. We don't have to be specific in terms of, we get the number here, like for example, you're getting 1474.9907 as some value, etc. It is a visual process, so it is not required to memorize these values or to get into the specifics of it. If it is visual, it is very clear that that at this point, for example, till here, we are seeing that the market is sort of taking out its high and we get a confirmation the next day. I think it is very clear that the increase in volume has been captured and that we are in what we could theoretically call as a breakaway gap. And in a breakaway gap, the characteristic of the breakaway gap means that whenever the market does come down to fill this gap, if at all, not necessary it will, but if it does, then it is a buying the pullback strategy that will be the general plan for the market. So therefore, because of a break of a range at a time when the US presidential election has just happened, at a time when the Indian markets are approaching the festive season, and there is a little bit of pent up demand, even fundamentally, for a lot of commodities and general products and supplies. So we should expect that there is value or there is money to be made playing the market on the long side. And with the presence of a breakaway gap very close to a clear cut failure of the bearish back pattern, and the market being in close proximity to its all time high of 12,400 plus, it should be reasonably safe to take a bet that the subsequent continuation gaps that will happen should, in more probability, create a new all-time high within the November series itself. So the general plan for the market should be to have a by and large long strategy. So whenever you're confused at a dip in the market whether to sell the break of a support or to buy it, you should try to buy it. And this is obviously manifested in our trade positions. So this I'll just share. These are currently the holdings that we have. So you could see that some of the stocks that we are owning are actually in very strong uptrends. So for example, JV Chemical. So if you just have a look at the stock, it's a real monster. And one of the ways to figure out that is, just remove this. One of the it's a clearly trending chart with the recent gap down support. So you can just look at this. It's a low volume ticker, but it's in the Nifty 500. The gap down support at 50-day moving 100, 50-day moving averages with the Marubozu candlestick is a perfect, absolutely perfect. And here, beautiful breakaway gap. This is a textbook definition of a breakaway gap. When this happens, the continuation move should be strong. The gap may or may never fill, and it should lead to a change in trend. So we are clearly seeing this, and we are seeing this that this gap actually happened at when this particular security was for a very long period of time in this particular range, and the other range was of course this one. So there were two ranges that were simultaneously playing on this, not simultaneously, with a little bit of gap, that were playing on this security. So and once and it was all the way from August to October, so a full quarter of absolute boring trading resulted in a BAM breakout and a clear-cut change in trend. So this, so just to share, so you will see, I mean, say Naveen Fluoride is another stock which is up. So for example, let's just consider. So you will have, just as theoretical consideration, if you look at it, that our average cost is 782.85. So just for theoretical interest, let us mark what we were seeing at 782.85. So yeah, so this is so it's very possible actually that I got in here. I mean, I don't remember the exact date, but it is very possible that I would have gotten here at this level. I mean, I'm just slightly confused about the date, but this is our entry zone. The stock, as you can see, didn't really break the low of this candle, which was a strong support. And then, I mean, this is just a beautiful picture when this happens to a stock that you're holding. Similarly, another stock that I want to just discuss is Naveen Fluoride. You can see that we have bought it at 2053 to be specific. And if we just see this, so yeah, so this is obviously uptrending chart. Obviously, there means it has ranged, but it never really broke the 50-day moving average. And this perhaps is the spot of 2053 is right here. Yeah. So it is possible that I either got traded in here, but if I remember correctly, Naveen Fluoride actually very quickly went into the money. So it is likely that we got traded on this particular candle, because after our entry, we know that Naveen Fluoride as a team, we know that did come to test our stop loss. It didn't trade it. It just, we were fortunate, lucky, however you put it. The market broke out, and so did Naveen Fluoride. It actually preceded the market breakout, and this is a very strong move, and it should not come as a surprise because it has historically been making very strong moves. So this, of course, these are of course the positions. Where are we? Of our say top two, and SRF. SRF has been a real monster actually. We bought it at 41.66. That means it's just a beautiful trade on SRF. It's always a pleasure to share good trades. Actually, it's rare that they happen, but when they do, it's always nice. So this here, you can see this. This is zone of. This is 41.65, more like somewhere around here. So SRF has structurally been in a range. It has structurally been in a range around this spot. We took a fundamental bet that this is a strong company that will benefit from the, you could say, the protectionist measures or anti-importing measures from countries which tend to dump their products into Indian market. We felt that the chemical space, the API space, there is likely to benefit, and stocks like Syngene, SRF, Naveen Fluoride are all a part of that actually group, the same group, and they were entered at different times, and this is one of the trades that has given. So it's a good clean breakout, and of course these are the profitable trades. We'll have to scroll down to see what's happening on the losing side, and we see that our top two or three losers are Reliance, Torrent Pharma, and Granules. So we will just have a look at, let's say, Reliance. So you can see that our entry is at 2238. If I can just, right. So we just have a look at Reliance as to why we took that entry and how things were looking at that time. So this is Reliance. So this right here is 2238, right? So this is how we were seeing Reliance at the time, and my argument was that this actually here is a bullish harami candle. It has come at a support of this quite big right in the gap. So I assume this is the gap that has come after an extended range and a bullish harami formation. At this red close, we wouldn't have entered. On this green close, we would have certainly entered. So this would have been the entry, but so it stayed there for quite some time, and we were hoping that it will take out this. Obviously, 2365 will be the first target for this, or 23 maybe 50 also could be a first target for this. The stock came under pressure, and then boom. This became the number one duffer stock that we have. We still have this, so I just want to see where the stop loss is for this. So if I just go to the GTT orders, I would have most likely put a stop loss for Reliance. I don't know. Unfortunately, I can't find it. Oh, it's right here. I don't know why it didn't show. So Reliance actually we have taken with a positional stop loss of 1778, which is whenever we took it, because the GTT orders are placed right as soon as we enter. Like it's very rare that we don't. So whenever we bought it with this stop loss. The reason for it are several, and fortunately for us, Reliance has now obviously formed a. This is obvious bullish engulfing Marubozu candle, and this is an obvious confirmation that is happening while we are speaking. So there is no doubt, as a fundamental investor, a trader is likely to is quite safe in buying this. With obviously you could buy it with us with a stop loss of 1775, and your first target. I mean, obviously since we entered at 2235, that will now become a resistance. So you could enter even now 2000 with a target 2250 with a stop loss of say 1750, and the second target 2350. And obviously if Reliance breaks this, which should take it a long time to do so, you could in what should generally be expected after we have a move like this is something along the lines here. I mean, this should be, in my view, the base case expectation. at least for Reliance, because it has a very strong trend. So if to understand how strong that trend is, we just have to shift the time frames to weekly, and you will begin to see that it's just a near vertical breakout. And on the weekly, actually, interestingly, as we speak, um, we are getting a hammer on the weekly. So you could be reasonably sure that this 1800 low is here to stay, and a positional trade on Reliance could be writing the 1750 put, 1760 put, whatever value exists for a very long time. And when Reliance reaches 2350, maybe you could, if you're selling two lots here, maybe you could consider selling one lot here at the time, depending on the market situation. That is, Nifty should be around 13,000 at that time for you to be taking up that trade. So anyways, that was Reliance, the thought process behind Reliance. And the other trade I think that we had discussed one was Granules, and the next one was Torrent. But Torrent has obviously been a slight bit of an embarrassment. Granules was a recent trade. We entered at around 380. So we entered right around here. For obvious reasons, it's clearly upward moving. There is very limited doubt. Even now, it's at its 50-day moving average, and we can see a sort of a consolidation happening. This looks like some sort of a hammer, but it is definitely not a hammer, because the theory is that there needs to be extended downward move, but that is not there. So we have absolutely no alternatives but to wait for Granules till the time our SL. I don't know why this is not showing it. It should ideally show it. But G, here we have Granules. So 342 is the SL. So 342 looks somewhere around here. I would like to add that each stock has more than one reasons for selecting an SL, and we bring the best of our understanding in a position when we are choosing one how to defend the stock, because actually trading is more defending, and very rarely do you have the opportunity of booking aggressive targets on single days. So this is the thought process. We hope that the market, just to conclude it, we have just discussed a breakaway gap. We discussed that it has happened with volume. We know that it is happening at the festive season in India. We know that it is happening at a likelihood of a resolution of the US presidential result. Our job becomes to back structurally uptrending stocks and to keep buying them on structural pullbacks, because the market has given a hint that it is likely to trend from here all the way till 13,000. And at 13,000, we have to be hyper alert for a bearish craft formation. And at that point in time, we must book out if at all it comes. But this has to be our general plan. And yes, just a quick, so these positions are of course shown even in our future positions right now. We have SBI, Bajaj, Finserv, Nifty, ITC, Hero Moto, Infi, and Long. Aarti, Dixon, Relaxo, this is I think Tube Investments. These are the targets that we have taken for the day, and these are the positions that are suffering right now. So MCX has been added today, and Hindi Unilever as a future, Dr. Reddy as futures, and Maruti as futures is obviously a clear-cut embarrassment. I'll not exit it. I'll hold it because the market is structurally moving upwards, and of course, all of these stocks have their. So we have more buy orders here, and they all of them have their stop losses without an exception. So hopefully, this video has shared with you our perspective on what is a breakaway gap, a general plan for trading Nifty in the future, and a little bit of an insight on what our current investments are and what our clients are currently doing with us. Hopefully this video was of benefit to you, and we meet online soon. Thank you. Take care.